Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Rob Harvey. He is from DFA, and we really focus the conversation heavily on DFA's investment philosophy, particularly the systematic nature and how they view markets and investing. But we did talk specifically about their Dimensional International Core Equity ETF, ticker DFAI. Talk about how that strategy has some premium tilts towards small size, value, and profitability. We talk about how it differentiates itself from other international equity ETFs. So without further ado, please welcome Mr. Rob Harvey. Hey, Rob, welcome to the show.
Hey, thanks for having me. Great to be here.
So before we get started, why don't you share a little bit about your background and how you ended up in your role over at Dimensional?
Yeah, sounds good. So when I first came out of undergrad, I wasn't working directly in asset management. I was working at Cisco Systems as a member of their treasury department. So I did foreign exchange trading. I ran their share repurchase program. So I was deep into capital markets. And one of the things that we did as part of that team was we oversaw a group of external asset managers that managed some of the cash that we had on our balance sheets. We had a roster of managers that we used. And we were just in the process of firing one of our managers because they got a call on the Fed very wrong year after year. So we got rid of them. And we opened up a search for a new asset manager. And one of the people that we talked to was Dimensional. So the asset managers that came in the door, obviously the first question that we're asking every single one of them is, what do you think the Fed's going to do? And where do you think rates are going to go? How are you positioning your portfolio accordingly? And everybody had an answer and everybody had a story except Dimensional, because their answer was, we don't think predicting what the Fed is going to do is a worthwhile exercise. So we don't do it, and we don't think you should do it either. Okay, now you got my attention because I haven't heard that response before. So I was curious about it. I wanted to learn more about their approach. I flew down to Santa Monica to attend one of their conferences there, where I got to see Eugene Fama and Ken French presenting some of their research and talking about their relationship with Dimensional. And I was just blown away. When you're in the front row seat, and Ken French is talking to you about the 3-factor model, it's like being in the front row seat of a Journey concert. It is an incredible experience. And I was sold. So when I went back to the Bay, I had advocated that we, use Dimensional as that asset manager that was missing. I don't know that it was a good fit for the way that everybody views the world, but for me at least, I had sort of a moment of introspection where I'm like, listen, if I like these guys so much and I want to put my money with them, why don't I go work for them? So I did. So I had wrapped up my MBA and I moved down to Austin, Texas, and I've been with Dimensional ever since.
That's a great story. And we're definitely going to dive into kind of some of the things how DFA thinks as we kind of go along with our conversation today. But before we dive into all the nitty gritty, I like to ask everybody, any hobbies, things you like to do when you're not working?
Yeah, so I've got 2 kids who are 6 and 4. So they're at the age where they really like spending time with me still. So I try to be into their hobbies as much as I can. And right now that means I'm into Pokemon and hockey, which I got to be honest those are not the worst hobbies in the world. I am very okay with that. So we're having a great time.
Yeah, I've got 8 and 3, and hockey is on our list. We're the 3-year-olds that learn to skate, and it's fun. I mean, but the 8-year-old is into travel soccer, and I was in 31-degree weather in Columbus, Ohio. And I'm like, what am I doing here? Like, why am I 3 hours away from home watching 8-year-olds play soccer?
That is one of the reasons why I'm supportive of my son doing hockey, because I live in Austin, and here it's not going to be 31, it's going to be 104. So I'm like, let's go to the rink. How about that? That seems like a better future for us here.
Yeah, love it. So let's get back into DFA. Like, can you give an overview of kind of DFA's mission and like everything you guys do really to help clients? Because you do a lot.
We do a lot. And our approach, I think, is different from that of other asset managers, because I think really, if you wanted to summarize it succinctly, you'd say Dimensional goal is to help end clients reach their financial objectives by providing great investment solutions. That's a little different from selling product. In fact, I'd say it's a lot different from selling product. And there's a few things that you see that are just very obvious right on the surface when you look at us versus other asset managers. You're not going to see Dimensional take out an advertisement in the Financial Times. You're not going to see us sort of promote our business and advertise here or there, because we're reliant on word of mouth advertising, really, which is you have a good experience with Dimensional, you like them, you tell your family, they learn something new, maybe about how their investments can be run, maybe an approach that they didn't realize was out there before, then they're interested and they talk to their financial advisor. And the financial advisor piece is critical, because we're very supportive of the advisor community. We don't have in-house advisors ourselves. We partner with advisors. And that's because we think the best way for investors to reach their financial objectives is by leveraging their financial advisor and listening to their advice. So it's a very strong relationship that we have with advisors that's, paid off quite well, both in the sense that we've all been able to benefit, right? Investors have had a good experience. Advisors have grown their business. Dimensional has grown their business. But it's because we're all playing on the same team. We all want the same thing. And it's not about pushing whatever's hot today. It's about thinking, what's going to make sense? What's going to drive long-term returns over the next 10, 20, 30 years? And there's a lot of ways you can support advisors, right? It's not just about product. It's about, you turn on the TV, there's a lot of news out there. There's a lot of noise out there too. How do you cut through that? How do you, stay relevant to your clients that you only see 4, 8 times a year, and have them stay focused on that plan when they're constantly being bombarded with all this other stuff? That's part of a responsibility that we're picking up too. And we're saying, we want to help you with that. So it's content, it's messaging, it's thinking about succession planning for the business. There's a lot that goes into that. And we're really plugged into the advisor ecosystem in that sense. It's not just great investment solutions, but we do that too.
Yeah, and you guys have been around for a long time. I think you were founded in 1981. And so, like, can you talk a little bit about the evolution of the firm, and then how you eventually got a little bit more accessible by getting into the ETF space?
Yeah, so the firm had its foundation in 1981. We had one strategy, which was a U.S. microcap fund. And the reason that we launched a microcap fund is because you couldn't get microcaps elsewhere unless you were just buying them individually. There was no fund available. There wasn't even really a benchmark available for U.S. microcaps. So we've kind of always been in the space of giving investors what they want and otherwise had difficulty getting a hold of elsewhere. So our heritage really has always been empowering investor choice and offering unique investment solutions. So as you said, we've grown quite a bit since then. We have, well over 100 products now that we offer. One of the ones that's important and very relevant for the advisor community is ETFs. As you said, we didn't have ETFs in 2018. It's a relatively new space for us to be in when you think about the longer history of Dimensional. But we're the number one active ETF issuer in the market. So we came at a point where we knew that we could be successful based on that partnership with advisors. And we have been. And we've seen that market share grow over time actually as well. So it's not just an early advantage that slipped away. We're actually, picking up steam in the active ETF space as well. Now, you mentioned before that some of the approach of Dimensional has changed, and that's absolutely true. If you wanted to buy a Dimensional mutual fund, you had to go through a process, and still do actually, of understanding how we view the world, because we think that's really important. If you're going to be invested in something like microcaps, you need to understand that microcaps aren't going to outperform large caps every day or even every year. That's part of the experience. And so if we care about helping investors achieve their long-term objectives, and it's clear that we do, right? That was one of the first things that I said. You have to also make sure that long-term expectations are set properly. So there's sort of an educational period where we share the research, we share what we're doing in the portfolios, we talk about some of the messaging that can be effective for advisors. So that's all part of buying the mutual fund. And we still have that. Even with ETFs, we want to work with advisors. We want them to partner with us and go to our conferences and speak to us and, sort of share thoughts on what would be effective. But you obviously don't have to do that with an ETF. You can just go out and buy it. So we haven't walked away from that investor education piece, but with ETFs, they're just more open. But, I think we're also being more aggressive with meeting people where they're at and making sure that the education is accessible to them.
You bring up a decent point with all the noise and the things that are going on in the market, and making sure investor education is there, and like talking about the explosion of the ETF space. Right, we've seen this growth over the last handful of years, even over the last year, of ETFs like defined risks and buffers. And like, I believe at DFA, you kind of think about it a little bit differently, that constructing portfolios to kind of weather all sorts of market cycles and not caring about the noise. So can you talk about the investment approach a little bit and how you guys think about that?
Yeah, definitely. One of the things that always kind of strikes me as odd is you'll have a conversation with an investor or an advisor who doesn't know much about dimensional, and they'll say, what's your best ideas fund? Tell me what your best ideas is. And that is really sort of a weird thought for me, because if you have good ideas, they should be in all your portfolios. So from our perspective is if you've found an area of the market that delivers higher expected returns over time, why wouldn't you be pursuing that in every one of your strategies? And we do. So we're very systematic in that way, right? So when you think about deviating from the market, which we do, we're an active manager. When you think about moving away from what the market portfolio looks like, you better have a good reason for doing that. Because if you don't have a good reason, you should just hold everything at market cap weight, basically. But we do have good reasons. And the reasons really is sort of that academic heritage that we're well known for, which is the greatest minds in modern financial theory, like Eugene Fama, Ken French, Robert Novi Marx, Myron Scholes, have chosen to work with us to help us improve our understanding of where returns come from, and then actually build portfolios around capturing that. So we have an enormous research team here with dozens of PhDs in it who take that research from academics and apply it in these portfolios. Again, systematically, meaning the bets that we're making on smaller securities, for example, doing better than larger securities, are there in all of our equity portfolios, and they're there every day. So if you believe in what we're putting out there, if you believe in the research, we're not switching from it. We're sticking to our guns over time. So there's a consistency aspect to that. Now, it doesn't mean, again, that they're going to outperform every day, but I think that consistency in approach gives investors more confidence because they know what they're going to see when they pick up the account statement. If value got crushed last year versus growth, you should expect to see your value strategy underperform. That is part of your, that's part of the experience that you should anticipate, right? It'd be weird if you picked up your account statement and your value fund outperformed the market when value didn't do well. So part of that, I think, is also just about setting expectations, like I said.
Yeah. So, everything you guys do relies really heavily on, academic research. So how do you at DFA, ensure that the factors you're targeting, such as size, value, and profitability, remain kind of robust in all different market environments?
Mm-hmm. Part of the evolution of the firm has been on the research aspect. So when I think about how Dimensional's grown, there's been two key areas I think that have been driving the growth. One is, how do you make your portfolios better? And that's what you're asking about, which is the research. And the other is, how do you offer investment solutions that better fit the needs of your clients? So I'll talk about the research piece first, which is, how do you how do you improve your portfolios over time? Because what we knew about the market in 1981 is not the same as what we know about the market now. So you should have an evolution there. You should have research that's coming out where people say, actually, you know what? Look at this area of the market. Isn't that interesting? There's some differences in returns here. We could do something with that. And there's always new research coming to light. There are hundreds of factors or premiums, whatever you want to call it, that are out there in the market. You need a team to vet all of those to say, are these worthwhile? Like, should we be pursuing these? And I think that deep bench of PhDs and researchers is incredibly important. My boss, Marlena Lee, is a PhD who worked with Eugene Fama at University of Chicago. She's very well equipped to have some of these conversations and has many times over the years and sort of evaluating this research. So there's a high bar for something coming into the portfolio. We're not chasing the flavor of the week. We need a lot of data and a lot of confidence that it's going to work, but we evolve. And there's a lot of evidence of that too. You think about profitability, for example, coming into our portfolios in 2012. We were doing small value for years and years and years before that. Profitability comes along and we vet it carefully for a long time and say, this is worth it. We should be implementing this. There's little tweaks, there's big tweaks, but you should always be moving forward. So what we look like today is going to be similar, I expect, to what we look like 10 years from now. But I also expect there to be developments and improvements. So that's the research piece. The product piece is also important. If we found ways to improve the microcap portfolio a little bit here, a little bit there over time, that's great. But we're not necessarily serving the investors, our clients, as well as we could if we know that we can also do things in other areas of the market that are also value add. So you've seen not just in the product wrapper, like ETFs, like you mentioned, but also where are you going to be positioning yourself? Like, and what are you positioning yourself against? Historically, dimensional has been very much a component of the market. Those are our flagship funds, like a value strategy or a small cap strategy. We do have market-wide strategies, but we're known for component strategies. Some of our most popular ETFs are low tracking error, high degree of overlap, market-wide portfolios with good implementation and very light tilts towards the premiums. People like that. And that's new for us. And we're not saying there's a right or wrong answer. It's all about risk preferences and, how much tracking error volatility you're interested in taking. But you can build portfolios that still incorporate those good ideas in just different flavors. You're just turning the knobs a little bit differently. And that has continued to evolve. And I fully expect to see that going forward as well. We are not done. You will see more ETFs. You will see more mutual funds launch in the future.
So you mentioned, the firm is active. How do you guys think about, that daily portfolio management process, really enhancing return and enhancing the approach compared to just buy and hold, let's just index?
Yeah. Let's talk about what's happened this month already. Okay? So we're halfway through April. How much has the market moved just in the last month? You could measure it even over the course of a day. How do you feel?
Yeah.
That's right. Sometimes I get a little nervous when we talk about things, and I haven't checked my phone in 20 minutes. I don't know what it's going to look like, right? Nobody knows. That's part of the environment that we're in. But if that's important to you and you want your asset manager paying attention, then you might want to think about what indexing looks like, because most indices only change their holdings once, twice, maybe 4 times a year. And we just talked about the fact that since last week, we've had an incredible amount of changes out there in the market that you should be paying attention to. So there's just a fundamental principle of how often would you expect your asset manager to be doing their job, which is looking at the portfolio and making sure that it's staying on track. I would argue it has to be every day. It has to be. So right off the bat, indexing, I think I've got some problems with that. But then on top of that, also, indices don't incorporate the research that's out there effectively on where investment returns are coming from. And that is also problematic. There's money that's being left on the table by sloppiness in implementation. There's money that's being left on the table by doing the same thing that everybody else is doing at the same time, and by only doing it once or twice or 4 times a year. But then there's another aspect, which is, why wouldn't you want to incorporate what, these academics who have spent their entire lives devoting to understanding where returns are coming from, why wouldn't you want that incorporated? You should. And we have a phenomenal track record of outperforming index funds on a net of fees basis, or indices, I should say, on a net of fees basis, which also means we outperform the index funds that are tracking them. So we've got the proof statement too. You can do better than indexing. It's a drum that we've been banging for some time now, because it's hard to get people to look beyond an expense ratio, but it's important. There's a lot more that's there. And by the way, when we talk about a dimensional fund, you're not paying that much more. It's fairly close to an index fund. But look, if you want to have your portfolio be looked at every day, you got to pay someone to do that. And so that's going to cost you a little bit more, but it is absolutely worth it.
Yeah, no, it was funny. Just going back to last Wednesday, I was on an airplane, had Wi-Fi, market's down. I'm in an Uber with a business partner of mine, and look at my phone, and the market's like, I don't know, I think it ripped like 8% in about like an hour. And I'm like, what is going on? Off a tweet? I'm like, what kind of world are we living in? But
yeah. And then remember the Monday before that, it was that, except it got reversed.
Yeah, so, right. The other way.
That is an area where it's helpful to have flexibility in your process, and it's also helpful to just have people paying attention.
Yeah, I totally agree. So on this show, we love to pick an ETF and dive a little bit deeper in it. Today, I want to talk through kind of the investment objective of DFAI, which is one of your funds. So really, can you give me a high level overview of DFAI and how it really is set up and how it works for investors?
Yeah. DFAI is one of those newer products that I've talked about before, where historically in all markets, you've had more of an emphasis on the premiums than DFAI offers you. So you would have a more substantial weight in small caps and value and profitability. So you'd have market-wide exposure, right? Your Toyotas are still in the portfolio, but they're going to be pretty far underweight because of the fact that you're going to be, emphasizing smaller, deeper value, higher profitability companies. DFAI is doing a similar thing in the sense that it is market-wide, and you do have some tilts toward the premiums. But one thing that we've heard from investors is, hey, I like what you guys do on the implementation side a lot. I like the flexibility in trading. I like, the fact that you're considerate about what's going into the portfolio. I don't know if I want heavy tilts. A little bit is fine, but I'm kind of trying to find a replacement for an index fund. So I want low tracking error. I don't want to look too different from the market. Great. DFAI is for you. DFAI is, again, as I said, sort of broad market capitalization coverage. It has thousands and thousands of names. In fact, it has thousands more names than you'll find in the MSCI World XUS, which is a very popular index to track for various funds that are out there in the developed international space. And the reason that we have all these names that you don't have in an index is because index funds and indices don't include a lot of microcap securities in them. And that's because it's very difficult for index funds to actually go out there and buy them. If everybody's trying to buy the same microcaps at the same point in time, it's going to get expensive. So index funds don't want that because it's going to mess with their tracking error, right? It's going to drive up their costs. So indices just don't include them. Well, the juiciest returns in the market come from microcaps. So you should expand your investment universe to include them. And we do, because we don't have to trade 4 times a year. We trade every single day, and in a way that we feel can be very cost effective to pick up some of those microcap securities. So DFAI, just from a construction standpoint, is different from the market. You've got better coverage. And one of the things I always hear investors talk about and sort of lament is, oh, there's no good small cap companies anymore. Everybody's staying private for longer. Nobody's IPOing. Like, if you buy the same stocks that everybody else is buying through an index fund, that is probably true. But it doesn't mean that there's not great companies out there that look like private equity a lot of the time based on, they're starting up their business, they're brand new, the profitability is not there, but man, there's a lot of potential for those. Those are in the microcap space. So that's important. So from a construction standpoint, there's that. But then just the implementation, as I talked about, just making sure that when you go to market, you're smart about the way that you do it. And maybe you don't want to hold everything out there in the market too. There's a lot of junky small cap companies, and there's companies that have, in the past openly declared bankruptcy and stayed in indices because nobody took the care to remove them. So there's just some basic fundamental principles that can be adhered to and should be that give you the edge. And when you look at DFAI's performance, it's been phenomenal over the last 3 years. It's outperformed its benchmark on a net of fees basis by a substantial margin. And we would kind of expect that from this portfolio. You're talking about, somewhere between, I don't know, 50 basis points to 100 basis points a year. Outperformance net is a great figure to put up for this fund. And again, the tracking error and the expenses are not very high. So very successful fund so far. And it's a great example of what we can do in other areas of the market as well.
Yeah, so you talked about kind of how the portfolio is constructed, putting in some tilts, but I believe DFAI also incorporates some shorter term considerations like momentum or short run reversals. So how do these tactical adjustments enhance the fund's performance, without maybe deviating from that portfolio construction process that you worked so hard to, build?
Totally. When you think about momentum, and that's a great example of something that is from the research that is something that should be incorporated into the portfolio. What momentum is doing is essentially looking at the path dependency of securities and how they wound up where they are. If you think back to when COVID first happened, we got a lot of questions and concerns from investors about certain industries like airlines or cruise ships. And people were saying, whoa, hold on, these look like value stocks because they got hammered, but please don't buy them because we don't know if we're ever going to get on a cruise ship again, right? That might just be a dead industry from now on. And we said, don't worry, we're not. And the reason is because of momentum, right? Momentum tells you that stocks that are getting crushed and massively underperforming their peers, you probably want to stay away from those because the tendency is that they're going to underperform over time. So that's a nice way for us to avoid value traps, for example. So it's kind of a different, sort of the same side of, or the different side of the same coin. And then you look at other stocks out there right now. What's doing really well in Europe? What's doing really well in DFAI? Defense stocks. They're doing really well. Those are momentum up. So if you have a portfolio that's focusing on smaller, deeper value, higher profitability securities, which is what we know drives returns in the equity space, but you're holding a defense stock that's in the top 5% in terms of performance for the rest of the international market, you might want to hold on to that one a little bit longer, right? So there's just sort of, it's not as rigid as looking at only the premiums. Momentum is a nice way of incorporating real world information into how did this stock get to where it is now? And what does that mean for what its returns look like over the next 2, 3, 4, 5, 6 months?
Yeah. So for, the financial advisor or the ETF portfolio manager that's listening to this, how should they think about incorporating DFAI into the portfolio? Is it best as a core holding? Do you see it as a sidecar? It's a traditional indexing? What are your thoughts?
DFAI is built to be a core holding. It's meant to replace the index fund that you have. And the nice thing is about it is because it has the broad coverage, but because it also achieves that outperformance that you're looking for, it gives you something that an index fund just can't do. We have to remember that index funds, you are guaranteeing yourself underperformance, or at the best case scenario, and very few index funds in the international space achieve it, but in the best case scenario, you're performing in line with the benchmark, which means if you're trying to outperform, you're really sort of you're fighting with one hand behind your back, right? You're taking away some of your options. So if you can find something that's scratching the itch that an index fund does, which by and large is going to be diversification and low cost, right? Broad market coverage, you can do that with DFAI in a vehicle that has achieved the outperformance, which just helps boost the overall, performance of the fund that it's a component of. So I think DFAI is really meant to be a replacement of the core part in international funds.
Yeah, no, I would agree. Rob, I really appreciate you taking some time with me today. This was great chatting with you. Before I let you go, where can people learn more about DFA and find information about all the different things you guys do?
A great place to start is on dimensional.com. So there's a tremendous amount of resources there. And there's also ways to get in contact with the Dimensional representative. We have a treasure trove of content and videos and just, the ability to connect with people to learn more about what we do and how we can be helpful for your business. So check it out. Make sure that you reach out to us. We'd love to hear from you. We're looking forward to it. And thank you for having me on.
Yeah, thanks, Roth. See you soon.